Well, we're now going to talk about unanimously our favorite topic, which is holidays. And the holiday season is upon all of us. There's a wedding season as well. It's been full-blown this time, I think the best in the last 5-6 years. Let's take a look at what this means for hotel rooms, for demand and businesses. Last we spoke, Indian hotels had occupancies at 70% and average room rates for Q2 were around 11,000 rupees versus about 8,700 rupees pre-COVID. Puneet Chhatwal, the MD and CEO of IHCL, joins us now to talk about that. Puneet, a pleasure speaking with you, and this is turning out to be one of the finest seasons that we've seen for the hospitality industry in a very long time. I remember the last time you spoke to us, you said that Q3 would be one of the strongest quarters in the last 10 years. And by the end of this year, you're looking at, I think you targeted about 5,600 crores of revenues for the full year FY23. Do you think you could do better than that?
Good morning, Sonia and colleagues. You're right. I said Q3 will be the strongest quarter. There is nothing that I know today which makes me change that statement. Demand is very strong. The wedding season is very strong. The business on the books is very strong. October, November have been good. And December is touching new heights. So I think all in all, we are very pleased so far with what we have seen in Q3. The 5,600 number was given by Mangalam. I never gave that number. So I would like to put a disclaimer on that. But yes, we will do well. And we will be definitely within or exceeding the guidance that we have given to the markets during our investor call and our results meeting, and also within the strategy of Avan 2025.
No, absolutely. Puneet, hi, good morning. The end of the second in Q2, Q2, of course, as you explained after that, was the fact that it's the weaker of the 4 quarters. Q3, of course, is the best. Margins, etc., are going to be, in that sense, very strong. You're saying that October, November has been very good, and December, no reason to believe it will be otherwise.
Yes, yeah. That's correct, Prashant. The margins are really driven by the pricing, and the pricing is driven by the balance between demand and supply. So demand continues to outpace supply, which means your ability to charge is higher. And Sonia said 11,000 rupees is a rate when you convert it into dollars is less than $150. We have a way to go. Rates all over the world have skyrocketed in the last 5-6 months. And even if we were to target 30% of comparable hotels and comparable cities or partner cities, I do believe that the rates will grow, and rightly so, because the rates in our sector on the domestic front have not really grown if adjusted for inflation in the last 10 years. So I think it was high time for the rates to increase.
Travelers like us, Puneet, if rates go up, I mean, the last time you said that luxury rates are going to go up by 25 to 30%.
I still maintain that. I still maintain it will be 25 to 30% increase in the luxury sector. Okay,
and doesn't bode well for people like us, right, to travel. But you also mentioned that, your margins could be closer to about 30% by the end of the year. With rates rising so much and the demand kicking in, do you think there is a potential to unlock higher margins than what you've spoken about?
Well, I think it's very relative. The good news is that we are talking about 33 at the end of the business cycle by 2025. That's the guidance we have given. We maintain that. We would like to exceed it. But, if we turn the clock back almost the last, let's say, 2010 till 2017, our average for the year was not even 15, 16. So if you're doubling those margins based on the snapshot of almost like 10 years ago and an average of 5, 6, 7 years, I think the sector that way and us in particular would have done very well, because we all know hotel industry is both capital intensive and a labor intensive sector, which is the reason why global hotel brands, and we are also a global company, find it very difficult to touch 30%. So if you're touching 30, we're doing exceptionally well.
Hi, Puneet. Morning. This is Nigel on this side. Puneet, I have many pleasant memories of Sea Rock. You guys have taken it over. The brokerages, well, some of them believe that that's a trigger as well. What's the pending formalities on that investment? And what is the total investment on this asset, Sea Rock?
See, Nigel, we have not yet done the full planning of CROC. It's still in a planning phase, and we are discussing with the city of Mumbai. We're also discussing with, BMC, MSZMA, and then the matter will be referred, because it's a very large development, it will go to the center for approval. All I can say is when you have me back within 6 months, not the next quarter, but the next 2 quarters, will be able to give some guidance. I think it's a great opportunity to have that mega development together with Land's End and to create the next landmark for the city of Mumbai, just like our founder Jamshedji Tata created the landmark in Kolaba. This could be the landmark in this era for the next 100 or 200 years to come.
Okay, well, all of us have great memories of Sea Rock, right? Especially if you were a child that was raised in Mumbai. But tell us about the new properties. I'm most interested in that. What is the outlook? By when do you plan to reach that 300 hotel target? And what can we look forward to over the next 6 to 12 months?
See, on Friday we signed or Thursday we signed our 250th hotel, which is going to be the Taj in Riyadh. Yesterday we opened a phenomenal, a very nice business property in Jaipur. We were always known for our palaces, the Rambagh, the Savai Man Mahal, the Jai Mahal, the Devi Ratan. But yesterday we opened the Taj Amer in Jaipur. We are absolutely on target or even ahead of target to open 18 hotels this year, which is the guidance we had always given. We will open 1.5 hotels a month, and we would sign 2 hotels a month, which means signings of 24, which get added to the pipeline, and an opening of 1.5. I think all of our brands are growing very strongly. Taj and Ginger both are destined to hit 100 hotels very soon. Let's say within the next 6 to 12 months. And that is phenomenal because that would make Taj one of the exceptional luxury brands across the globe to have 100 hotels. And also we are continuing on our selective growth on the international front based on management contracts instead of doing single asset acquisition, which we did, let's say 20 years ago. So all in all, I think from a growth point of view, we are very satisfied. And I think our growth is a leading example for the hospitality sector in terms of last 3 years, having the highest number of signing of rooms, hotels, opening of rooms, opening of hotels. So, and I don't see this trend changing, at least in the next short term or mid term, as as and how you would like to call it.
Right. Puneet, sort of zooming out from Indian hotels to looking at the sector, you've been someone who's spoken about Indian hotels, but also, of course, been an advocate for the industry as well. And this is an important industry, as the recently released GDP numbers showed us, right? The contribution of what they describe as trade, hotels, and transport as a category grew some almost 15%. But in absolute terms, this sector is pretty much the same size it was in 2019, which was pre-COVID. And the graphics are all up on your screen. As the consultations start, industry feedback starts, representations to the government are made as we head into the next budget, what should be, in your opinion, done? Because this is people intensive as well, an important kind of linchpin in the employment generation aims for the government. Go on.
Thank you, Prashant. I think that's an excellent question you raised because it's an opportunity. It's an opportunity for the country. And as you can see, the Q1 was even 25%. As the sector was badly hit, the good news is it's back to 1920 levels, but the rate of increase in the jobs is on the way up and is exceeding any other sector in India today. More importantly, this sector globally creates the maximum number of indirect jobs. In India, the data is a bit tweaked, as we all know, because some of the jobs are in the unorganized sector. So if we were to adjust for that, I think the opportunity is huge. the contribution of tourism and hospitality sector is expected to reach 3 trillion by 2047. If we get this sector, the infrastructure status at the center level and the industry status at all the states of India, I think there will be a huge increase in the investment in this sector. So while constructing, you will have jobs. While building infrastructure, you will have jobs. And once the properties open up, more and more jobs directly in the hotels would be created, but also indirectly in terms of vegetable suppliers, in terms of other supply chain. So it's a huge opportunity and is definitely in line with the government's endeavor to create new destinations under the Udan scheme, new airports, etc. So I think if the sector was positioned and granted the proper status that it rightly deserves, I think these numbers could look much better and assist India in getting as close as possible to a double-digit GDP growth in the years to come.
Okay, all right, Puneet, thanks so much for stopping by. And on that optimistic note, we'll wrap up on this interview, but we look forward to having a chat with you rather soon and wishing you a rocking December. Looks like things are full up at your end. Well, let's move on then. The cement space has been buzzing around. Pricing has improved. Demand on ground, we understand, by a lot of brokerages like Jefferies. They have written that demand is improving and input costs are cooling off. Well, looks like an ideal scenario, right? So to understand that and more, we're joined by Mr. Anil Singhvi, Executive Chairman of Sri Digvijay Cement. And then we'll be joined by Rajesh Ravi, Institutional Research Analyst at HDFC Securities as well. Hi, Mr. Singhvi. Good to have you on the show after a while. Well, is demand bouncing back to the extent that you expected? October, November should be looked together because you had festive season, in different parts of both these 2 years. That's 2021 and 22. And also for your company, earlier you were guiding for around a 10% volume growth. You stick to that because first half has been soft.
Thanks, Nigel. Thanks for having me today on your show. Two things. One is, of course, the demand is picking up. One has to take October and November together because last year Diwali was in November and this year Diwali was in October. So if I take the two together, I'm very, very happy that demand is really now perking up. November especially was very, very good, which is really boding well for demand to go on till about May or June before the monsoon. So I think we'll be growing much better than what even I was expecting in September. September was looking a little subdued because demand was just not coming into the double digit. But from now on, I think the demand will be double digit till at least May or June. As far as Digvijay is concerned, we have had a very good last month. Demand was very good in Saurashtra and in Gujarat per se. So I think happy days are here again as far as demand is concerned.
And happy days in terms of profitability as well. Mr. Singhvi, hi, good morning.
Hi, good morning.
Because you've got petcoke prices which are coming off. On the input side as well, inflation side as well, are things looking a little more reasonable now?
Well, there is some softening of the petcoke and coal prices, but one doesn't know. I would still not bet on that the prices are, secularly going to go down. But definitely they are looking, much softer than what they looked in June, July. I hope there is a bit more clarity on the pricing of petcoke and coal. Oil, of course, is coming off. So I believe that petcoke also will come off. And once petcoke comes off, I think coal will come off. So I think it's going to be a cascading effect. But I think it's early days for us to count on really softening of the prices in a big way. 5-10% decrease is not going to really help us so much. But on the flip side, I think we need to look at it how the demand will perk up the cement prices. Cement prices have been subdued. In fact, they have been tracking much lower than inflation for the last 12 months.
Mr. Singhvi, good morning. I just had one follow-up question on demand because, you have your ear to the ground. You know how things are moving. Is this demand coming in from a lot of the government capex? Are you looking at a big pickup in private capex? Is it more infrastructure demand, real estate? Just trying to get some color on where things are moving.
Sonia, I think let me put it in perspective. I think it's coming from all sectors, still governed by largely on account of real estate, whether individual or institutional. And the secondary infrastructure also is picking up. I think we are getting into a little bit of a confidence mode, if I may use that word, whether it is be government or the individual or institutional consumption on that. I think even the government point of view, the GST collections, the tax collections, I think things are looking up much better for them to start spending money. So is the capex cycle for the private sector. And individually, I think it's also a reflection of how you see the economy.
Okay.
I think we were looking very, very dangerously in June, July, because inflation was looking to be a big threat. But I think those threats are really coming off. And cement, as you know, is a long-term perspective. It's not a 1 month consumption or 2 months consumption. So once you start a house, you don't stop it. But you start a house after taking into consideration many aspects. Okay. So I think this is where I believe that the demand will be here to stay.
Okay, all right. Mr. Singhvi, just to get a couple of numbers, the volume growth will be 10% and EBITDA per ton will trend how much higher? Last quarter was around 600 rupees per ton. So how do you see this shaping up?
I don't think I've ever spoken on future as a believe that
on the volume front, so on the volume front, you told us you were expecting 10%. So at least you stick to that. On the profitability, it could be up in the air. But
yes, and I want to just put it this, that September quarter was one of the worst quarter for the industry, though we did much better. Our 600 rupees was perhaps the first 4 or 5 cement players in the country, because most of them did about 400 or 500. So 600 was pretty good, but I think according to me, that was the worst quarter I have seen in my recent memories on that. Going forward, I think the EBITDA per ton will be much better than what we did, because it was high coal prices, demand being low, monsoon months, everything what could go wrong went wrong during September month. So
absolutely.
we are out of the perfect storm, I would say this way.
Okay, out of the storm is always a good thing. Rajesh, Ravi has been sitting by very patiently. Rajesh, thank you for your time. Can you give us your top stocks? What are the stocks that you're still bullish on since demand is picking up, and what are the target prices?
Yeah, hi, good morning. In terms of our top picks, among cement majors, we are bullish on Ultratech and Dalmia Bharat. Even ACC valuations is cheap compared to where Ambuja is. So we prefer these companies, preferentially Ultratech followed by Dalmia. And in mid-cap space, we are bullish on JK Lakshmi and Nubuco.
Okay, all right. Hi, Rajesh, morning. Give us a couple of numbers. What for the industry? What was the EBITDA per ton in Q2? As Mr. Singhvi said, it was one of the worst. And for the industry, what kind of an improvement on the EBITDA per ton you're factoring in for Q3 and then Q4?
Sure. So for the quarter gone by, the industry average was around 530 rupees EBITDA per ton. And as Mr. Anil Singhvi mentioned, it was obviously one of the worst quarter in the recent, I would say, obviously in at least 7-8 years, and things are obviously the industry for sure is out of a storm. And in Q3 onwards, there are multiple triggers, as he also conquered that demand is holding up well, and that is where we believe that there should be at least 100 rupees improvement on the realization side sequentially. Additionally, on the costing side, if you look at the cost trends, from the peak of July and August, September, the coal prices, petcoke prices, all of them, primarily the coal prices, which were on a per kilocal basis north of 4 rupees, have now tapered down to closer to 3.5 rupees. And even imported coal, even the domestic imported coal prices have gone up in the last 2 months. They're still hovering around, less than 3 rupees. So 2.5 rupees. So what is happening is that coal and petcoke both are converging closer to 2.5 rupees per kilocal, which is at least 1 rupee lower compared to what we have seen in the quarter gone by.
Yes.
However, will all of this will play out in Q3? Certainly not, because people have different inventories and then logistic challenges. So yes, there will be some benefit. We are factoring in around 100 odd rupees saving, which should come through in this quarter, and then a major saving should be seen in Q4 and Q1.
Okay.
So these 2 quarters, Q3 and Q4, we should be, from an industry perspective, 200 odd rupees, 200 odd minimum margin improvement we should be factoring in Q3 from 530 levels, and in Q4 there should be at least 300 rupees margin improvement.
Okay, all right. So going by what you're saying, the industry EBITDA per ton will move from 530 closer to around 1,000 rupees per ton. Well, Mr. Singhvi, a final question before we let you go. When we last chatted, you told us in the next couple of months, maybe there will not be any consolidation. But in the coming quarters, you're expecting some consolidation. Have you picked up anything? Are you expecting something to take place in this fiscal itself? I'll tell you, I have my ear to the ground, and I believe that in the next month and a half or so, a couple of assets could change hands. Smaller assets, relatively very, very small assets. But what's your sense?
than I have because of the age factor. I'm much older than you, so obviously I can't hear the sound bells that you can hear. But definitely, I believe that the industry will go through some consolidation. It won't be in the hurry, as I mentioned to you.
Yes.
It may take time. Smaller assets, yes, they may go through because you don't require much of both work to be done and much of the money to be spent on those. But definitely 23. So let me not put 1 or 2 quarters, but 2023, the full calendar year, you'll see a lot of consolidation happening in cement industry.
Oh.
Because every positive factor is there. So now you don't have to worry about demand, about the pricing. And more or less, we are peaking out on in terms of cost of production. The cost of production will come down here on. So I think it's looking very, very good play, both from the point of investment values and for consumption.
Okay, Mr. Singhvi and Rajesh, thanks so much for stopping by. 2023 is shaping up very, very well as per what Mr. Singhvi and Rajesh as well says. Let's see whether or not that holds true, and maybe it could be a year of consolidation as well. But Sonia, let's get back to the markets. We went to around 18,570 and we have bounced 40-50 points, as was the call earlier today.
Oh, absolutely. And, you know, there are plenty of stocks that are moving around. So let's get Mitesh Thakkar into the conversation now. The Nifty is holding at 18,600, but big moves coming in the banks. Look at Punjab and Sindh Bank, 9% higher now. Bank of India is up about 9% and Union Bank is up 7%. So the charts will be up for you. Mitesh, first, before an update on the market, on these banks, I mean, is there more traction left or from a technical standpoint? And if yes, which are the ones that you still like?
Sonia, I think from a medium-term perspective, I like all of them. You know, PNB, Union Bank, Canara Bank, etc. Bank of Baroda, add to the list. But in the short term, they're extremely overbought. So if somebody is buying, I think try and figure out a very tight stop losses, because there could be some pullback happening to the moving averages. I think though on a medium-term basis, as I said, I think the chart patterns are very, very good, and also is the fact that the outperformance will also remain for these stocks. So yes, a good sector, not the best entry point given the run-up which we have seen for the last few days. So on a pullback, I would be wanting to buy them. On the stock side, Pidilite is a buy. That's a stock, which is giving a good breakout on the hourly chart. So buy here with a stop at about 27.40 or just below it, and a target of 28.30 can be looked at. While on the sell side is Metropolis, that's breaking down. Keep the stop about 14.60, look for targets of 13.80.
Okay, thanks a lot for that. So that's Metropolis on the downside. But banks are really the big movers. IDBI Bank, Bank of Maharashtra, anyone you pick actually, South Indian Bank, all up anywhere between 2 to 4%. But the Shriram Group has formally announced the structure of the merged entity yesterday. As is known, the promoter company Shriram Capital and the SME lender Shriram City Union were merged into the group's flagship Shriram Transport effective April. Lata caught up with Vyas Chakravarti, the MD and CEO of Shriram City Union Finance, and Umesh Revankar, the Vice Chairman and MD of Shriram Transport Finance, began by asking their respective roles in the merged entity. Listen in.
Day-to-day running of a business and business management will be done by Mr. Chakravarti. I'll be looking to a broader objective of a long-term prospect of the company, business strategies and building synergy. So that is to be the role. So even otherwise, we will be we're talking to each other wherever needed.
Okay. Mr. Chakravarti, okay, so you will be the operational guy. Can you tell us when will it be listed? When will the listed Shriram Transport share reflect the merger? Is it in a week or two?
Actually 2 weeks. That's why you're pushing for, probably mid of December.
Okay. And if you can tell us what will be the merger cost, Mr. Chakravarti? I mean, things like duties, etc., and other costs. How much did it cost the group?
So it's actually the stamp duties have costed us about 200 crores odd.
Okay.
And the total cost of the merger would be about between 400 to 500 crores.
Mr. Revankar, I have an operational question. I can understand that when you all merge, there will be the guys who were selling in Shriram City Union, their gold loans and SMEs will continue to do that. Those who sold CV loans will continue to do that. But at the upper echelons, there have to be people who know both businesses. How does that triangle work? Are you all sure that it will bring synergy benefits?
Yeah, what we have done, in fact, is we have 5 joint managing directors in a respective geography who have known both the businesses to some extent. and even otherwise they are in the business for more than 25 years to understand the overall needed requirement of operational skills that is required. And we are also working for nearly 1 year now, and we have been talking for nearly 3 years. So it has got into our, I should say, blood that we should be doing multiple product and multiple services to the customer. And we believe that increasingly the customers are also getting exposed to multiple products. No more that customer is just focused on single product, and he also has multiple requirements. So we feel that with this merger we'll be able to meet his requirement on all his requirement or all his needs on all his services.
Okay. Mr. Chakravarti, do you see any immediate benefits, synergy benefits that will flow? I mean in terms of growth or margins or pace of growth?
See, the immediate benefits, what I'm looking at is our ability to increase our penetration of SME loans, and also increase in gold loan branches, where we can actually leverage on the network of Shriram Transport Finance's branches and the experience of that team. So these are the two products that we see that we should be able to push.
Okay. You know, there was your NIMs didn't show much difference. I mean, Shriram Transports, that is, in the quarter gone by. But there were some people who were saying the calculated NIM had fallen a bit. How do you see the net interest margins in the current and next quarter, Mr. Chakravarti? That's a more immediate question because, you know, money is getting expensive.
I'm sorry?
Will your margins get crunched because the cost of capital is rising?
No, Lata, we don't think so. And we are in a position to absorb another 25-30 bips of increase. So, and without increasing our cost, number one. Number two, without compromising on our NIMs also. So hopefully, we are pretty confident that the next 2 quarters we'll be able to hold on to whatever the NIMs that we have been able to, show for the September quarter.
Well, time to slip into a short break, but on the other side, we'll shift focus to the commodity segment. Manisha Gupta is waiting for us.
So the market has recovered from the lows, definitely down about just 0.3%, but there are plenty of stocks which are under pressure. Metals are taking a big knock this morning. SAIL, Tata Steel are all down, and then you have all your platform companies. So whether it's Zomato, which is under pressure, something like an Easy Trip is also down about 6%, some profit taking there. But shifting focus to the commodity markets now, Manisha Gupta is joining in. Manisha, morning. What's the one commodity you're tracking?
Thank you for that, Sonia. Well, we have seen most of the non-ferrous metal continue to decline, but the ferrous metals still seem to be holding firm. So whether it is about steel or iron ore prices, we have seen trades continue to be on the positive side. Iron ore especially is trading at a 3-month highs, and for the month of November, it was the first monthly gain in 7 months that we saw the commodity put on, and iron ore prices are trading 28% higher in the last 1 month itself. If you look at the overall price mechanism on how it really has worked, this year's high has been $171 per ton. We did see a low at 76.5. That was in the month of October sometime, and we have seen an all-time high pardon me, in case of iron ore at $224 a ton. That was in last year, and the current price is trading at 108, is lower than this year's high and nearly half of what we have seen as an all-time high in the previous year as well. The reason you have seen this kind of a volatility in prices clearly comes in from China, because 2/3 of all iron ore that is seaborne is consumed within China itself. And China in the last year did have that policy that housing is for living, not for speculation. And since then, we have seen a decline come in for many of those metals there. The housing sector itself, the real estate, all of that saw a decline. This is the data from China yet again, Jan to October 2022, whether it has been about national home sales, property investment or new construction. As you can see, it has been a sharp decline in this year. So China to the road of recovery, yes, but can these numbers and how soon can these numbers turn into positive or even flat is something that the street will have to really watch out for. In the meanwhile, this is the World Steel Association report, which says that in 2022 till time right now, we have seen a decline in iron ore demand from China and European Union, and the global number as per them is down by 2.3%. So we are looking at a contraction in this year as compared to the previous year. this is what we are seeing in sense of demand for this year and the next year as well, where you are looking at a much lower growth expectation coming in, and that is perhaps going to continue to weigh in case of the iron ore prices there. This is what we have seen in sense of the global markets, where we are looking at Chinese demand continue to decline. European Union is down as well, but the Indian output is up by 6.4%. One of the very few countries where you are looking at a higher production when it comes to the global steel there. The price views or the future forward really is going to be about the China COVID restrictions. How do they play out? The US fund policy, the whole markets are in a jittery because of that as well. And there are reports on how China will replace old steel capacity with electric arc furnace. That would mean that we perhaps have seen iron ore imports or demand peak out already in 2021 in case of iron ore. This is the view from ING in sense of 2023. They're expecting a big range in the next year. The quarter might start with $85 and the fourth quarter might end with $95. So they're expecting the prices to consolidate or even go higher. When it comes to the other reports, the expectation is S&P especially thinks that $105 of an average is what you could be looking at in sense of iron ore prices.
Okay, thanks a lot for that. So that is on the metal space. But one sector that's rallying hard now is PSU banks. Nimesh is here to tell us more about that. Nimesh, there's a Morgan Stanley note on PSU banks?
That's right, Sonia. So Morgan Stanley has gone ahead and further raised the target price, multiples and earning estimates across all the PSU bank stocks. They believe while the stocks have done well this year, they expect continued strong performance on the back of higher margins, sustained loan growth and improving operating leverage over the next few years. Within the PSU bank stocks, they believe Bank of India and Bank of Baroda are well placed on a relative risk-reward basis. So they expect loan growth to sustain and credit costs to remain benign over the next few years. In terms of stock prices, while they continue to be underweight on Canara Bank, on there they've raised the target price to 345 versus 280 earlier. On Bank of Baroda, they have an overweight stance, but they've raised the target price to 220 now versus 195 earlier. On Bank of India, they've sharply raised the target price to 125 versus 95 earlier, and hence I believe Bank of India is up 10%, largely on the back of that big upgrade. And on PNB, they have an equal weight stance, but they've raised the target price there as well to 60 now versus 40 earlier. So target price increase, multiple increase, as well as earning estimates are increased by Morgan Stanley, and hence the entire PSU basket is buzzing in trade today.
Okay, thanks a lot for that. Let's slip into a quick break on that note. On the other side of the break, Lata will be joining in. She'll connect with Vetri Subramaniam of UTI Asset Management, his outlook on 2023. We, of course, turn 23 tomorrow as well. So more on that in a bit.
Welcome back. We turn 23 tomorrow. And we are ushering in our birthday celebrations today with someone who is a tad older than us in the markets, but who has been with us for the better part and who, like us, believes the market is our best teacher. Welcome, Vetri Subramanian, the Chief Investment Officer at UTI Asset Management Company. Vetri, thank you very much for joining us on the eve of the celebration. We are kicking off our celebrations now. Since you've observed the market for almost 3 decades now, does it look like the Indian investor, the Indian saver, has definitely become an investor? Is that one of the big paradigm shifts, if you please, of the last couple of years?
Yeah, thanks, Lata. That's a very interesting question. And first of all, delighted to be here. I think the first time I appeared on your channel was precisely 24 years ago. So it's wonderful to have been part of the journey with CNBC-TV18. I think, certainly there is a big story in terms of the fact that I think the sheer size and numbers that we are seeing in terms of the growth of the Indian investor base is something quite remarkable. I remember going back to, the late 98, 99, when I used to be on the broking side, on the retail broking side. In fact, it was a very disappointing period because, the number of active investors weren't really going up. And I would say that's a story which sort of stayed unchanged for almost 10 to 15 years. And it's only during the previous decade, sometime in the middle of the last decade, where we suddenly saw the number of active investors, be it whether you look at the mutual fund route or you look at the unique number of demat accounts, these numbers really started to take off. And, that is why I think the whole, discussion around financialization of savings, we've always known that the Indian investor has saved, but the preferred avenues were gold and property, but they have now started to divert a lot more of their money into financial assets, and particularly the mutual funds and stocks directly. And I think that's helping to broad base the market, and it also helps create a pool of long-term capital, because for entrepreneurship to flourish, you don't not only need good entrepreneurs, but you also need a large pool of capital. So I think the equation is looking a lot more balanced today than it was 20 years ago.
Now, there's a reason why I brought that as a paradigm shift. One of the oft-repeated complaints about India's all-time high record at this point is that valuations are too high. Are we likely to remain that way simply because there is a huge domestic pool that's coming by?
That's not a very appealing argument for me, Lata. What I've learned the hard way over 30 years is that valuations do mean revert. There are times where they will trade significantly above the average, but they will find reasons at some point to once again trade below the average. Now, that may be too extreme a approach to use as an investment policy, which is to only wait for extremes to either reduce or add equities. But at least we'd like equities to trade back into what we call sort of a fair value zone. By the way, as recently as June, July of this year, we were actually in the fair value zone, but with the push up which has happened in India as well as with global markets over the last few months, we've again pushed back into rich territory. So I don't think there is anything such as trading at a permanently high plateau in terms of valuations. And I'll also make another point here, Lata. It's useful to not just look at valuations of equities relative to history, meaning we look at where the PE is, we look at where the price to book is, maybe where the dividend yield is relative to history, but it's also useful always to look at where do equities trade relative to a very simple asset class, which is, say, bonds. And today, when we compare the 10-year bond to equities, actually the needle is shifting in favor of bonds rather than equities. So from that point of view, I would actually say that right now it's the bonds which are looking reasonably attractive, particularly high quality bonds. You aren't actually getting rewarded for taking any level of credit risk. The credit premiums are too small, but high quality bonds, including sovereigns, certainly a very attractive trade just based on the historical relationship of bonds versus equities.
Oh, then you wear your CIO hat and tell us, is the immediate choice fund balance advantage?
Certainly, I think the whole range of hybrid schemes are far more interesting at this point of time, because you are getting the potential of much better yield on the debt side of your portfolio. I think most investors today perhaps still look at what their bank is offering them on one-year deposits, but the banks haven't actually opened up that rate as much. And in fact, they are borrowing in the CD market at much higher rates than that. So, you could buy a reasonably high quality mutual fund portfolio with a duration of less than 2 years, which is sitting at yields, portfolio yields. So the net yield would be lower, but the portfolio yields could be as high as 740, 750. So, to my mind, that is an attractive opportunity for investors, not just the hybrid option, but equally even the fixed income products with, up to 2-year, 10-year, 7.5% is attractive.
Okay. Well, I wanted to come to sectors in just a bit, but my producer is showing all the key holdings in your FlexiCap fund. So I'll come to it very quickly. First up, are you expecting the coming years to be, next couple of years, where we have some visibility, to be very good earnings growth years? We saw, I think, a 40% Nifty EPS growth in FY23, in FY22. FY23 has been more sober. I see estimates ranging between 10 and 12%. Will 24 be much better? So is equities continuing to be a good bet?
So good question, Lata. I think, if I look at the direction of earnings growth revisions, they've been to the downside, right? So if you go back a few months, the Nifty 50 earnings growth for 23 was perhaps closer to 17-18%. That number for FY23 has now dropped to about 12%. If I look at the 24 number, the earnings growth was forecast at one point to be higher than 20%. That is also now dropping and coming down to about 18-19%. So the direction of earnings cuts seems to be to the downside at this point of time. And I would, therefore have some concerns about valuations and the potential for further earnings cuts. There is also another, I think, issue we need to think through a little bit more clearly, Lata. I think there's too much discussion. Obviously, you have the RBI policy tomorrow. I'm sure you're going to spend a lot of time discussing that. But I don't think the issue is any more limited to what does the RBI do. I think what's happening in the marketplace in terms of cost of capital is actually far more interesting, because we've got credit growth running at 17-18%, yes. Deposit growth, for some of the reasons I mentioned earlier, running much slower, and you've got an economy which is now going to be looking for where do we get capital to grow from. And if this starts to pull the rates higher in the market, forget what the RBI does. They'll do 30 basis points, 40 basis points. But I am a bit concerned about India's ability at this point of time to fund the growth for next year, because the situation in terms of liquidity in the system is looking tight. And if that causes rates to move up in the market, that could be something which could, eventually come back to hurt equities as well.
Okay. I was going to ask you whether you're going to bet on capex stocks next year. You've kind of partly answered it. I mean, that question was mainly because in your list of stocks in FlexiCap, L&T holds a prime position. Now, we all know that this is the finance sector, the financial sector, or rather the banking sector has been the winner in the current year, in 2022. What would be the next best sector for you? I mean, even you are heavily invested in finance stocks, in banking stocks. What is the next best sector?
Very difficult one today, Lata. I'd say if I look at the last 1 year, the areas that we've liked, automobiles going back a year ago, it's done well. Valuations have now put up more to sort of mid-cycle. Same for financials. We were very positive a year ago. But again, over there, valuations have moved up. And, we're glad to see those prices do well and therefore pull those valuations up. So there isn't really too much in that sense which is now looking attractive. If I just step back for a moment, Lata, let me describe the problem. The problem is when you take a top-down view on India and the stuff which is domestically related, you can feel sanguine about the growth outlook, but you are already paying a very high valuation for that. We can discuss whether it is just moderately expensive or extremely expensive, but anything to do with domestic is now getting priced very, very fine. Now that becomes difficult if you are to make incremental money or extract alpha from it. So, really from my point of view, if I had to go and look for where are the pockets of the market where actually the top down is negative, but perhaps in some cases the valuations have now moved in favor of the value seeking investor, then you are more likely to find it in cyclicals which have more of a global exposure rather than the local exposure, right? So if the US recession turns out to be shallow, stocks which are exposed to business outcomes in the US could, actually surprise. If China starts to back away from zero COVID, as we've seen in recent days, and starts to sort of look at their economy more constructively, that could again be a positive surprise. Because remember, the consensus discounted in those sectors which are exposed to these areas is very, very negative. So really it's a question of, is something going to improve for the better, or is something which is likely very well placed, but if it's already priced for perfection, then you have really no, short-term advantage, so to speak, over there.
Okay. I've been warned that I'm out of time. I'm going to try and get a one-line answer from you. Can the balance shift to mid and small cap? They are the guys who have underperformed.
Not on our valuation metrics, Lata. I think the large caps look the best placed. Mid caps, I would say, is sort of in the same territory. The small caps are something where we think valuations are still not favorably placed.
Oh, that's a most useful conversation. Thank you very much, Vetri Subramaniam, for being part of our 23 years and our 23rd year celebrations as well. Have a great one ahead. We have to wrap up on Bazaar. Chartbusters up next.